Stop everything. It's January 20th, 2026, and I need to have a very serious conversation with you right now. Silver is sitting at $95 per ounce as I'm recording this, and I know exactly what's running through your mind. You're looking at your stack. You're looking at your gains. You're seeing numbers you never thought you'd see. And you're asking yourself the question that every single person who's made life-changing money asks, when do I sell? I'm William Lee, and over the last 7 months, I've received thousands of messages from people in this community. People telling me they paid off their credit card debt with their silver gains. People telling me they eliminated their student loans. People telling me they paid off their cars, their medical bills, that they now own their vehicles free and clear. I've had retirees message me saying that the gains they've made on silver have completely transformed their retirement security. They went from worried about making ends meet to having genuine financial breathing room for the first time in years. And to every single one of you, I want to say congratulations. I am genuinely deeply happy for you. What you've accomplished is remarkable. You saw the opportunity when silver was at $33. You had the courage to act when everyone else was laughing. You had the discipline to hold when the price started moving and doubt crept in. And now you're sitting on gains that have changed your life. But here's what I need you to understand right now, today, at $95 silver, making money is hard. But keeping money, that's even harder. And knowing when to take profits, when to rotate, when to reposition, that's the difference between people who build lasting wealth and people who ride the elevator all the way up and then all the way back down. So in this video, I'm going to give you my complete exit strategy. I'm going to tell you exactly what I'm doing with my silver right now. I'm going to show you the framework I use to make these decisions. And I'm going to explain why some of you should absolutely be taking profits right now, while others should be holding every single ounce. But before we get into the strategy, I need to address something that I've been seeing in the comments and in my messages. Some of you are saying, William, you didn't give us enough warning. You didn't give us enough time to buy silver before it took off. And I want to be very clear about this because it's important. That statement is factually incorrect. And let me take you back. In 2023, I made multiple videos talking about the structural problems in the financial system, about the inevitability of currency debasement, about why hard assets were going to outperform. In 2024, I made a video called The Great Melt-Up, where I explained why the stock market was going to record highs because of what the Federal Reserve and the government were doing with monetary policy. It's a 10-minute video, and at exactly 9 minutes and 42 seconds into that video, I explicitly stated that you should buy silver. I didn't say maybe consider silver. I didn't say silver might be interesting. I said you should buy silver. That was 2024. Then, 7 months ago, when silver was at $33 per ounce, I released a comprehensive video laying out my entire thesis. I showed you the supply-demand fundamentals. I showed you the currency debasement trajectory. I showed you why the risk-reward was asymmetrically in our favor. The information was there. The warning was there. The opportunity was there. Now, I'm not saying this to be harsh. I'm saying this because it's a critical lesson about investing. Opportunities don't wait for you to be ready. The market doesn't care about your savings schedule. The market doesn't care that you were planning to buy next month. When the setup is there, you either act or you don't. And if you didn't act, that's okay. There will be other opportunities, but you need to own that decision and learn from it. Which brings us to right now, silver at $95. And the question everyone is asking, what do we do next? Here's my framework, and I want you to pay very close attention because this is the foundation of every decision I make with precious metals. In order to know when to sell your silver, you cannot, I repeat, you cannot price your silver in US dollars. You have to price your silver in gold. It's called the gold to silver ratio, or GSR. And if you don't understand this concept, if you don't use this framework, you are flying blind. Let me explain exactly how this works because this is critical. The gold to silver ratio is simply comparing how cheap or expensive silver is relative to gold. It's a ratio, it's math, it's objective. Here's how you calculate it. You take the current price of 1 ounce of gold and divide it by the current price of 1 ounce of silver. So for example, let's say gold is trading at $5,000 per ounce and silver is trading at $100 per ounce. You divide $5,000 by $100 and you get a GSR of 50. What does that mean? It means it takes 50 ounces of silver to buy 1 ounce of gold. The GSR is telling you whether silver is cheap or expensive compared to gold at any given moment. Now here's the question I know you're asking. William, why are you comparing silver to gold instead of comparing silver to US dollars? Why not just say, I'll sell when silver hits 100, or I'll sell when silver hits 150. Why complicate it with this ratio? The answer is fundamental, and if you understand this, you'll understand why so many people lose money even when they're right about the direction of an asset. The US dollar is a fiat currency. It is backed by nothing except the full faith and credit of a government that is $36 trillion in debt and adding another trillion every 100 days. The purchasing power of the dollar is being systematically destroyed by design. Comparing silver to dollars is like measuring distance with a rubber band that's constantly stretching. The measurement itself is unreliable. You might as well compare silver to monopoly money. I'm not being dramatic. I'm not ranting. I'm telling you this so you understand the logic of the framework. If you want to analyze historical data, if you want to know whether silver is genuinely cheap or expensive, you have no choice but to compare silver to gold, not silver to dollars. Because here's the problem with using dollars. If you ask me, is silver cheap or expensive right now, adjusted for inflation? The honest answer is nobody knows exactly. Why? Because what inflation rate are you using in your analysis? The CPI that the government publishes? That's a lie. It's been called the CPI lie for a reason. The government has every incentive to understate inflation because Social Security, government pensions, and bond yields are tied to it. The real rate of inflation over the past 30 years, the past 50 years, nobody knows the exact number because the methodology keeps changing and the basket of goods keeps getting adjusted to show lower inflation. So if I'm trying to do historical analysis using dollar-denominated prices adjusted for fake inflation numbers, I'm building my entire strategy on quicksand. But gold is real. Gold has been money for 5,000 years. Gold is the constant. So when I compare silver to gold, I'm using precise, factual, objective data. I can look back 30 years, 50 years, 100 years, and the gold to silver ratio gives me a clear picture of whether silver is cheap or expensive relative to its historical norm. Let me show you what the GSR looks like over the past 30 years because this is where the strategy comes into focus. Historically, when the GSR is in the 60 to 80 range, that's normal. Silver is neither particularly cheap nor particularly expensive compared to gold. The ratio fluctuates. It goes up, it goes down, up and down, but there's a clear pattern. And the pattern is simple. When the ratio is high, silver is cheap relative to gold, so you buy silver. When the ratio is low, silver is expensive relative to gold, so you sell silver and rotate into gold if you want to stay in precious metals. The theme is timeless. Buy low, sell high, make money, enjoy your life. When I made my video 7 months ago telling you to buy silver, the GSR was above 100. Let me repeat that. The gold to silver ratio was above 100. That means it took more than 100 ounces of silver to buy a single ounce of gold. Historically, that's extreme. That's silver being severely undervalued compared to gold. And that's why I said in that video that this was an asymmetric bet. The risk to reward was so lopsided in our favor that not taking the trade would have been the riskier decision. The downside was limited. The upside was enormous. And we had history on our side. In that original video, I told you my exit plan. I said that once the GSR gets to 50, represented by a specific threshold, I would start selling. And I want you to understand something very important. I didn't pick the number 50 randomly. I picked it based on historical analysis. When the GSR compresses to 50 or below, that's typically near the end of silver's outperformance phase. It doesn't mean silver crashes. It means that silver has run hard, volatility increases, and the risk-reward is no longer asymmetrically in your favor. On January 14th, 2026, just 6 days ago, the gold to silver ratio fell slightly below 50, and I sold 25% of my paper silver position, specifically my SLV, which is the silver ETF that I hold on the stock market. And I want you to know that on my Patreon community, I notified everyone immediately. I always post what I'm going to do before I do it. Transparency matters. Accountability matters. So right now we are 25% out of our original silver position. We've locked in gains. And because silver nearly tripled from where we bought it, by selling just 25% of the position, we've almost completely recouped our original investment. That means the remaining 75% of our silver is essentially a free roll. It's house money. The pressure is off. Now, if the GSR continues to fall, meaning if silver continues to outperform gold and the ratio drops to 45, 40, or lower, I'm going to continue offloading more of my position in increments. And if the GSR rises back up, if silver underperforms and the ratio climbs back to 60, 70, or 80, I will buy back that silver. This is not emotional. This is not a belief system. This is capital allocation based on relative value. Now let me address the questions that I know are flooding your mind right now, because I've been getting these questions non-stop over the last week. Question number 1, William, won't silver keep going up? Why are you selling if you think silver is going higher? Listen carefully. I am not selling because I think silver is going to crash tomorrow. I'm not selling because I've lost faith in the precious metals thesis. I am selling because my thesis has partially played out and because relative values matter. Let me explain what that means. When I bought silver at $33 with a GSR above 100, the asymmetric opportunity was clear. Silver was cheap relative to gold. The risk was minimal. The reward was substantial. But now, with silver at $95 and a GSR at 50, the situation has changed. Silver has already outperformed dramatically. Volatility is increasing. and the risk is no longer asymmetrically in our favor. Does that mean silver can't go higher? Of course not. Silver could absolutely go to $110, $120, $150. I'm not ruling that out. But what history shows us is that when the gold to silver ratio compresses quickly, silver often overshoots in the short term and then underperforms gold in the following phase. That doesn't mean silver crashes. It means gold tends to become the better vehicle for the next leg of the precious metals bull market. Think of it like this. Imagine you're running a race and silver just sprinted the first mile at world record pace. Could silver keep sprinting? Maybe, but probability says that after a sprint, there's usually a period of slower pace or even a rest. Meanwhile, gold, which has been jogging steadily, might be ready to pick up speed. I want to be positioned for the next phase, not married to the last phase. Question number 2. If I sell my silver, what do I do with the money? This is absolutely critical, so pay attention. What I'm doing is a rotation, not a liquidation. I am staying invested. I am not selling silver and going to cash. I am not sitting on the sidelines hoping and praying for a crash that may never come. We are in the middle of the great melt-up. The government is printing money. The Federal Reserve is lowering interest rates. Financial asset inflation is accelerating. The government is telling us that the purchasing power of our dollars is being devalued at a rate of 2.7% per year, according to the official CPI. I call complete BS on that number. It's not 2.7%. If you go to the grocery store, if you pay rent, if you buy a car, you know it's not 2.7%. The real rate is much, much higher. So if I sell my silver and stick that cash into a savings account earning 3.5% interest, I'm losing money to inflation. I am getting poorer in real terms even though my nominal balance is growing. I refuse to do that. I refuse to lose purchasing power by sitting in cash. Can the markets crash? Sure, it's possible, but they also might just keep going up. The Fed is printing. They're cutting rates. Why would I fight the Fed? All I know is that if I stay invested in real assets, in productive assets, in things that generate cash flow or have intrinsic value, then over the long term, prices are going to keep going up thanks to monetary debasement and financial asset inflation. So when I sell 25% of my silver, I'm immediately reallocating that capital. I'm rotating into other assets that I believe have better risk reward at current prices. Maybe that's gold. Maybe that's undervalued stocks. Maybe that's real estate. Maybe that's Bitcoin. The specific allocation depends on what looks most attractive at that moment based on relative value, but the key point is I stay invested. Question number 3. What about dollar cost averaging? This is one of the most important concepts in investing, and it applies just as much to selling as it does to buying. When I buy a position, I like to dollar cost average in. I typically do it in 2 to 4 increments, usually about 3 batches. For example, if silver is at $33 per ounce and I like the setup, I'll buy some. If silver drops to $30, I'll buy more. If it drops to $27, I'll buy my third batch. By doing this, I know I'm not going to get the absolute best price, but I also know I'm not going to get the worst price. I'm getting it generally correct, and I'm smoothing out my entry to reduce the impact of short-term volatility. It's the exact same principle when I'm selling. I want to sell in increments. I want a dollar cost average out. I already offloaded 25% of my position when the GSR hit 50. I still have 75% remaining. If the GSR continues to compress, I'll sell another 25% at a lower ratio, then another 25%, and so on. By doing this, I know I'm not going to sell at the absolute top, but I also know I'm not going to be the guy who holds all the way up and then all the way back down. I'm smoothing out my exit, locking in gains progressively, and reducing risk as the trade matures. This is discipline. This is how you build wealth over decades, not just during one spectacular trade. Question number 4, what about your physical silver? This is extremely important, so listen carefully. In addition to the paper silver I own through SLV and other instruments on the stock market, I own physical silver, coins, bars, tangible metal that I can hold in my hand. And my rule is very, very simple. Paper silver gets sold first. Physical silver gets sold last. Why? Because paper silver and physical silver serve different purposes in my overall strategy. Paper silver is a trading position. It's liquid. I can sell it instantly with the click of a button. It's efficient for taking advantage of price movements and rotating capital based on relative value. Physical silver is insurance. It's wealth preservation. It's my hedge against the possibility that the financial system breaks down faster or more severely than I currently anticipate. If I eventually decide to sell my physical silver, it will only be after I'm completely out of all paper positions. And even then, I'll probably keep a meaningful amount of physical metal just in case. Because there are scenarios, low probability but high impact scenarios, where physical precious metals are the only form of wealth that maintains purchasing power. I'm talking about scenarios involving currency collapse, bank failures, payment system breakdowns, or severe social instability. Do I think those scenarios are likely in the next few years? No. But do I think they're possible over the next decade or two? Yes. And the cost of insuring against those scenarios by holding physical silver is relatively low compared to the potential benefit if one of those scenarios unfolds. So my physical silver is not for sale at $95. It's not for sale at $120. It might not be for sale at $150. That metal serves a different purpose. Question number 5, would you buy silver again if the price drops? Absolutely, without question. If the gold to silver ratio justifies it, I will rebuild the position. This is not an emotional attachment to silver. This is not a belief that silver is inherently better than other assets. This is pure capital allocation based on relative value and risk reward. If silver underperforms gold, and the GSR climbs back to 70, 80, or 90, that means silver has become cheap again relative to gold. And if the fundamental thesis around currency debasement and precious metals still holds, which I believe it does, then I would be a buyer again. I have no ego about this. I have no loyalty to any particular asset. I go where the value is. Now let me share my final thoughts on this because I want to be absolutely crystal clear about where I stand. I am still bullish on precious metals as an asset class. I still believe we're in a long-term secular bull market for gold and silver driven by currency debasement, fiscal insanity, and the breakdown of the post-World War II monetary order. I am still protecting my wealth against the systematic destruction of fiat currency purchasing power. What I'm doing right now by selling 25% of my silver is not bearish. It's disciplined, I'm reducing volatility, I'm locking in asymmetric gains that I achieved by buying when the risk reward was heavily in my favor, and I'm repositioning for the next phase of this bull market. That's not weakness, that's strength. That's how you compound wealth over time. Let me give you some historical context so you understand why this approach works. If you look at the history of precious metals bull markets, they don't move in straight lines. Silver especially doesn't move in straight lines. Silver is the most volatile of the major precious metals. It tends to make explosive moves to the upside, then violent corrections, then consolidation periods, then another explosive move. If you bought silver in 2010 at $20 and held through the spike to $49 in 2011, you felt like a genius for about 3 months. But if you didn't take any profits, if you just held because you believed silver was going to $100 or $200, then you watched it crash back to $30 by the end of 2011. And then you watched it grind lower for years, bottoming around $14 in 2020. The people who made generational wealth from that 2010-2011 silver rally were not the people who bought and held forever. They were the people who took profits near the top, rotated into other assets or even into cash temporarily, and then bought back when silver was cheap again. They played the cycle. They didn't marry the asset. That's what I'm doing now. I'm playing the cycle. I made an asymmetric bet when the GSR was above 100. That bet paid off spectacularly. Silver nearly tripled. Now the GSR is at 50 and the risk reward has normalized. So I'm taking partial profits, staying invested in other assets, and waiting for the next asymmetric opportunity. And here's something that most people don't understand. Gold and silver generally move in the same direction over the long term. They're both precious metals. They're both real money. They're both hedges against currency debasement. When one goes up over a multi-year period, the other usually goes up too. Right now, the GSR is at 50. But let's say over the next year, the price of gold doubles and the price of silver doubles as well. If both double, the GSR stays at 50. So maybe silver goes to 190, maybe it goes to $300. But if the GSR doesn't compress further, if it stays at 50 or even rises, I may not sell my remaining silver. I'm not selling based on a dollar price target. I'm selling based on the gold to silver ratio. This is why I cannot tell you to sell at $100 or $120 or $150. I don't know what gold is going to be doing at those prices. If gold goes to $10,000 and silver goes to $150, the GSR would be 66, which means silver would actually be cheaper relative to gold than it is right now. In that scenario, I wouldn't be selling. I might even be buying more. The framework is the GSR. The framework is relative value. The framework is not arbitrary dollar price targets. Now let me talk about something that sounds simple, but is actually incredibly difficult to execute. Buy and hold. Everyone talks about buy and hold like it's easy. Just buy and hold, bro. Diamond hands, never sell. But the reality is that buy and hold is psychologically brutal when you're sitting on massive, unrealized gains. I know a lot of people in this community who got extremely nervous when silver hit $50, then $60, then $80. The gains were so large that fear started creeping in. What if I lose it all? What if this is the top? Should I sell now and lock it in? That psychological pressure is real. It's intense. And most people can't handle it without a framework. The reason I didn't get nervous at $50, $60, or $80 is because I had a plan. I set my target based on the GSR. I decided in advance that I would start selling at a GSR of 50, and I stuck to that plan. Having that framework removed the emotion. I wasn't guessing. I wasn't trying to time the top perfectly. I was executing a predetermined strategy based on historical data and relative value. That's the difference between people who make money and keep it versus people who make money and give it all back. The latter group has no plan. They're reacting emotionally to price movements. They sell too early out of fear or hold too long out of greed. The former group has a plan, trusts the plan, and executes the plan regardless of what their emotions are screaming. Let me address one more thing before we wrap up, and this is critical. You must stay invested. That's my opinion, especially in this type of environment. We are living through the greatest monetary experiment in human history. Central banks around the world are printing currency at unprecedented rates. Governments are running deficits that would have been considered insane 20 years ago. Debt to GDP ratios are exploding. The purchasing power of fiat currencies is being systematically destroyed. In this environment, holding cash is a guaranteed way to get poorer. Even if you're earning interest, if that interest rate is below the real rate of inflation, you're losing purchasing power. You're watching your wealth evaporate slowly but surely. So when I sell 25% of my silver, I'm not going to cash. I'm rotating into other real assets. I'm staying invested in things that will benefit from currency debasement and financial asset inflation. Maybe that's gold. Maybe that's stocks of companies with pricing power. Maybe that's real estate. Maybe that's Bitcoin. The specific allocation depends on relative value at that moment. But the overarching principle is stay invested in real assets. Don't sit in cash waiting for a crash that might never come. The Federal Reserve has shown us over and over again that they will print whatever amount of money is necessary to prevent a deflationary collapse. They will sacrifice the dollar. They will sacrifice savers. They will do whatever it takes to keep asset prices elevated. Fighting that is pointless. Complaining about it is pointless. The only rational response is to position yourself to benefit from it. Own real assets. Own things that can't be printed. Own things that maintain purchasing power when currencies are debased. That's how you build wealth in this environment. Now, I want to end with a message specifically for those of you who are sitting on large gains right now. If you bought silver at $33 and it's now at $95, you've nearly tripled your money. That's life-changing for a lot of people. And I want you to really think about what that money represents. For some of you, it's the difference between debt and freedom. For others, it's the difference between anxiety about retirement and confidence about the future. For others, it's the ability to take care of your family in ways you couldn't before. These gains are real. They matter. And there is absolutely nothing wrong with taking some profits and using that money to improve your life. Don't let anyone shame you for selling. Don't let anyone tell you that you're weak or that you don't have diamond hands or that you're betraying the cause. This is your money. These are your decisions. Your circumstances are unique. Your goals are unique. And if selling some or all of your silver right now makes sense for your situation, then do it with confidence. But if you decide to hold, if you decide to ride this all the way to whatever comes next, then make sure you have a plan. Make sure you have a framework. Make sure you know what conditions would cause you to sell. Because if you don't have a plan, you're going to make emotional decisions at exactly the wrong time. My plan is the gold to silver ratio. That's my North Star. That's my framework. When the GSR compresses to certain levels, I sell silver. When it expands to certain levels, I buy silver. It's objective. It's based on historical data. It removes emotion from the equation. You might use a different framework. You might have different targets. You might have different risk tolerance. That's fine. The specific framework doesn't matter as much as having one and sticking to it. What I can tell you with certainty is this. We are still in the early stages of a major precious metals bull market. The fundamental drivers, currency debasement, fiscal insanity, geopolitical instability, supply-demand imbalances, all of these factors are still in place and accelerating. Gold and silver are going significantly higher over the next several years. But the path won't be straight. There will be volatility. There will be corrections. There will be moments of doubt. And the people who navigate this successfully will be the ones who have a plan, who manage risk, who take profits when risk-reward is unfavorable, and who reload when opportunities present themselves. I've sold 25% of my paper silver. I'm holding 75%. I'm keeping all of my physical silver. I'm staying invested in real assets. I'm watching the gold to silver ratio like a hawk. And I'm prepared to adjust my positioning as conditions change. That's my strategy. That's my framework. Take from it what's useful for your situation and ignore the rest. But whatever you do, make a decision. Have a plan. Execute the plan. And don't let fear or greed derail you from building the wealth and security you deserve. Silver at $95 is not the end. It's just the beginning of the next chapter. Trade smart, stay disciplined, and enjoy the wealth you've built. This is William Lee, and I'll see you in the next one.